Have you ever wondered why some people seem to grow wealth effortlessly while others struggle to make ends meet? What if you could wake up every morning knowing your money is working for you, even while you sleep? The secret lies in investing. Unlike simply saving money in a bank, investing allows your money to multiply over time, creating financial security and freedom. But where do you start? How do you ensure you're making the right moves? This guide will walk you through everything you need to know, from understanding the power of investing to choosing the best options for growing your wealth. Whether you're completely new to investing or looking to refine your strategy, by the end of this article, you'll be equipped with the knowledge to make your money work for you. The foundation of wealth. Understanding how money grows. Money sitting in a savings account barely grows. Most banks offer interest rates below inflation, meaning your purchasing power decreases over time. Investing, on the other hand, allows your money to grow through the power of compound interest. This concept is often referred to as interest on interest. It means that when you earn a return on your investment, that return is reinvested, allowing it to generate even more returns in the future. Over time, this compounding effect can turn a small investment into a significant sum. Imagine investing $1,000 in a stock or fund that grows at an average annual rate of 10%. After a year, your money grows to $1,100. The next year, instead of just earning interest on the initial $1,000, you now earn $1,100, bringing your total to $1,210. Over a decade, that initial $1,000 could turn into nearly $2,000, $2,600 without you adding another cent. The longer you keep your money invested, the more powerful compounding becomes. Setting your financial goals. The first step in investing. Before putting your money anywhere, it's essential to define your investment goals. What are you investing for? Some people invest to build wealth for retirement, while others do it to afford a home, fund their children's education, or simply achieve financial independence. The goal you set will determine your investment strategy. Your risk tolerance is another crucial factor. If you are someone who prefers stability and wants to avoid losses, you might lean towards safer investment options like bonds and index funds. However, if you're willing to take on more risk for the potential of higher returns, stocks and real estate may be better choices. Your timeline also plays a role. If you're investing for a goal 30 years away, you can afford to take more risks compared to someone who needs the money in 5 years. Exploring different investment options. One of the biggest mistakes beginners make is thinking they need a lot of money to start investing. The truth is, you can start with as little as $5. There are several investment vehicles available, each with its own advantages and risks. Stocks are one of the most popular investment choices. When you buy a stock, you're purchasing a small ownership stake in a company. If the company does well, your investment grows in value. Some companies also pay dividends, which means you earn money just for holding the stock. While the stock market can be volatile, history has shown that it grows over the long term, making it an excellent option for wealth building. For those who want a safer approach, exchange-traded funds, ETFs, and index funds are great alternatives. These funds are collections of stocks that track the overall market performance, reducing risk by diversifying your investment. Instead of betting on a single company, you're investing in multiple businesses at once, increasing the chances of steady growth. Bonds offer another option for those looking for stability. When you invest in bonds, you're essentially lending money to a company or government, and in return, you receive regular interest payments. While bonds don't offer high returns like stocks, they provide a level of security and predictable income. For those looking for a virtually risk-free way to store money, high-yield savings accounts and certificates of deposit, CDs, provide a safe alternative. While the returns are lower, these options can be useful for short-term savings and emergency funds. Developing a smart investment strategy. One of the most important principles of investing is starting as early as possible. The earlier you invest, the longer your money has to compound, leading to exponentially greater growth. Even if you can only invest small amounts initially, consistency matters more than the amount. A common strategy is dollar-cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This reduces the risk of making poor investment decisions based on short-term market fluctuations. Diversification is another key principle. Placing all your money into one stock or one type of investment can be risky. If that investment fails, you could lose everything. Instead, spreading your money across different assets, stocks, bonds, real estate, and even international markets reduces risk and increases the likelihood of stable returns. Emotional investing is one of the biggest pitfalls to avoid. Many people make investment decisions based on fear or excitement, buying stocks when prices are high and selling when they drop. Instead, it's important to make decisions based on research and long-term goals rather than short-term market movements. Taking action. How to get started with investing. Getting started is easier than you might think. The first step is opening an investment account, such as a brokerage account or a retirement account, like a 401k or IRA. Many platforms, such as Robinhood, Fidelity, and Vanguard, allow you to invest with little money and no experience. Once you set up an account, the next step is deciding how much to invest each month. Even small contributions can lead to significant growth over time. Avoiding common investing mistakes. A common mistake among beginners is trying to time the market, waiting for the perfect moment to buy or sell. Even professional investors struggle with market timing. Instead of focusing on short-term movements, it's better to invest consistently over time. Another mistake is investing without research. Before putting money into a stock, fund, or property, it's crucial to understand how it works, its risks, and its potential returns. Relying on trends or following what others are doing can lead to poor investment decisions. Conclusion: building a future of financial freedom. Imagine a future where you no longer worry about money, where your investments generate income and you have the financial freedom to travel, retire early, or spend more time with family. That future is possible, but it requires action. Investing is not just for the wealthy. It's for anyone willing to take small steps toward financial independence. The sooner you start, the greater the benefits. Your money has the potential to work for you, but only if you let it. So, are you ready to take control of your financial future? What's the first investment you're going to make today? Thanks for watching. Don't forget to like and subscribe to our YouTube channel.